Hey everyone, welcome back. I'm so ready to jump into this deep dive because honestly, the stock market, sometimes it feels like a giant puzzle, right? Like, how does anyone crack the code?
It can definitely feel that way, yeah.
And so many of you have asked for like a market analysis crash course. So today, that's exactly what we're doing. We're going deep on two major approaches, technical analysis and fundamental analysis.
Great topics, both of them.
And I think it's fascinating how different these two approaches can be. With technical analysis, it's like we're studying the market psychology. There's emotional waves that drive prices up and down.
Exactly. Technical analysis is all about those patterns and trends, like are there recurring movements in the market that we can sort of begin to recognize? And if so, can we use those to anticipate what might happen next?
So it's a bit like trying to predict, I don't know, like the mood of a crowd. Not by talking to individuals, but just kind of observing the energy, how people are moving together.
That's a great way to put it. Technical analysts really believe that because we're creatures of habit, humans, that we make similar decisions, even in investing, based on those past experiences.
It's like that saying, history might not repeat, but it often rhymes, maybe.
Right. And that's where charts come into play. Line charts, candlestick charts, they all tell a story.
And those candlestick charts, they've always been my favorite. I don't know, I just find them so visually interesting, each one like a little snapshot of the day's trading activity.
Exactly. That's a great way to think about it. So a candlestick with, say, a long green body, that means buyers were in control that day, pushing that price up. A long red body, sellers were in charge.
So green's good, red, maybe not so much. Got it. But it's not just about those individual candlesticks, right? We're looking for patterns.
Exactly. Let's say you see a stock price bouncing off a certain price level multiple times, almost like it's hitting an invisible ceiling. We call that a resistance level.
Okay, so it's like that price becomes a psychological barrier almost.
Right. And one of the core ideas in technical analysis is that past resistance can become future support and vice versa.
So it's like the market's memory is kind of embedded in the chart itself.
Precisely. Even one of the simplest patterns, a trend line, can be incredibly revealing. Connect those higher highs on your chart and boom, you've got yourself an uptrend. When that price breaks below the trend line, could signal a shift in momentum.
Almost like everyone was feeling bullish, optimistic, but suddenly they're getting a little more, skittish.
Exactly. Now, this goes back to that efficient market hypothesis we've talked about before. Technical analysts believe that if all publicly available information is already factored into a stock's price, these chart patterns might give us a glimpse into what's next, based on how the market has reacted in the past.
It's like they're not trying to outsmart the market, they're trying to understand its language.
Exactly. They're looking for those subtle clues.
So in addition to these trends and patterns, what other tools do technical analysts use to speak this market language?
Well, that's where technical indicators come in. They're basically calculations using price and volume data to try and identify trends, momentum, even potential reversals.
Okay, so if chart patterns are the words, indicators are like the grammar, helping us understand how those words fit together.
Love that analogy. And there are a bunch of them out there. One you've probably heard of is the RSI, the Relative Strength Index. It measures how quickly and dramatically a stock's price has moved. Basically, it tells you if a stock is potentially overbought or oversold.
So like even if a stock is on a tear, going up and up, the RSI might be that little voice saying, hey, maybe take a breather. This pace can't last forever.
Exactly. Think of it like a car going uphill. It can only maintain that speed for so long.
Got to find a nice flat stretch to cool down the engine, right?
Right. Another popular one is the MCD, the Moving Average Convergence Divergence. Sounds complicated, but it's really about spotting potential buy or sell signals, comparing different moving averages.
So it's less about the absolute numbers and more about the relationship between them.
Precisely. Like, if that short-term average crosses above the long-term average, it might suggest a bullish move is coming.
Okay, I'm liking all these early warning signals we're uncovering. What else is there?
How about Bollinger Bands? Imagine these two lines on your chart, almost like a channel that contains most of the stock's price action. When those bands narrow, it tells us volatility is low, which often means
a big move is coming, like that moment when everyone's holding their breath.
Exactly. But which way will it break? That's the million-dollar question, and unfortunately, no indicator can predict that with 100% certainty.
So even with all these charts and indicators, it's more about probabilities than certainties.
Exactly. It's like having a better map, not a crystal ball.
Right. You might know the roads, but you can't predict the traffic.
And that's where risk management becomes crucial. Technical analysis can help you time those entry and exit points, but you absolutely need a plan for what you'll do if the market, throws a curveball.
Makes sense. It's about being prepared, not just trying to predict the future.
Absolutely. So while technical analysis helps us kind of ride those emotional waves of the market, fundamental analysis, well, that's a completely different beast. That's about looking under the hood, understanding what truly makes a company tick.
It's like we've moved on from reading those market tea leaves, and now we're about to, savor the actual tea itself.
I like that.
So with fundamental analysis, it's about understanding those core ingredients, those fundamentals that truly determine a company's worth.
Exactly. It's about looking beyond those short-term market swings and really assessing the underlying business. Is this a solid investment? Is this company built to last?
And where do we even begin to answer those questions?
Well, a good place to start is with the company's financial statements. Think of these as the company's autobiography, but written in numbers. You've got the income statement, the balance sheet, and the cash flow statement.
Okay, so let's crack open this numerical autobiography, shall we?
Mm-hmm.
What kind of stories does the income statement tell us?
The income statement, that's going to show us how much money the company made, their revenue, and how much they spent their expenses over a specific period of time. Could be a quarter, could be a year.
So it's like a financial performance snapshot.
Exactly. And the bottom line of the income statement, that's the net income or the profit, tells us how much money the company actually made after all those expenses were paid.
Got it. So higher profit, generally a good sign. But I imagine it's not quite as simple as that, right?
Yeah.
Two companies could have the same profit, but one might be running a much tighter ship, so to speak.
That's a great point, and that's where profitability ratios come into play. One of the key ones is the profit margin. It tells us how much profit a company generates for every dollar of revenue, so a high profit margin. Usually a good indicator that the company is using its resources efficiently.
It's like they're squeezing every bit of lemonade out of those lemons.
Exactly.
Okay, so we've looked at the income statement. What about the balance sheet? I'll admit the name always sounds a little, static.
Right. It does, doesn't it? But think of the balance sheet more like a snapshot in time. It shows everything the company owns, its assets, everything it owes to others, its liabilities, and then what's left over for the owners, which is the shareholder equity.
Right, so assets, things like cash, inventory, equipment,
Mm-hmm.
liabilities, those are debts, obligations, and equity, that's the kind of residual value for the shareholder.
You got it. And just like with the income statement, we use ratios to help us make sense of all these numbers. One important one is the debt-to-equity ratio. That tells us how much debt a company is using to finance its assets.
Okay, so a high debt-to-equity ratio, that could be a bit of a red flag, right? Like taking on too much leverage.
It could be, yeah. It really depends on the industry and the company's specific situation. But generally, a lower debt-to-equity ratio is seen as more conservative, less risky. Then you've got the current ratio, which measures a company's ability to pay its short-term obligations.
So it's a measure of their short-term financial health. Can they keep the lights on, pay their bills?
Exactly. It's all about making sure there's enough cash readily available.
Okay, so we've covered the income statement, the balance sheet. Now for the grand finale, the cash flow statement. I've always heard that cash is king, but why is that?
Because cash flow is the lifeblood of any business. It shows us the actual movement of cash, both coming in and going out. The income statement might tell us a company is profitable, but the cash flow statement reveals if they're actually collecting that cash from their customers.
Ah, so a company could look good on paper, but if they're not generating real cash flow,
Yeah.
that's a problem.
Big time. And one key metric here is free cash flow, or FCF. It represents the cash that a company has left over after paying for its operating expenses and capital expenditures. It's the cash they're free to use for things like paying dividends, buying back stock, or investing in growth opportunities.
It's the money they can play with, essentially.
Exactly.
Okay, so we've got these three financial statements. We're crunching ratios. Is that all there is to fundamental analysis? Are we done with our detective work?
Not quite. Remember, we talked about qualitative factors. Those are a bit harder to quantify, but just as important.
Right. It's about looking beyond the numbers.
Exactly. Things like the quality of the company's management team, how strong is their leadership, what's the competitive landscape like, are they operating in a cutthroat industry, or do they have a solid moat?
It's like you can have a fantastic recipe, but if you've got an inexperienced chef in the kitchen,
things might not turn out so well. And then we have to consider the company's overall business model. How do they make money? Is it a sustainable model? Are they adapting to changes in technology and consumer behavior?
It's about understanding the bigger picture, the long-term trends that could impact the company's future.
You got it. And that's what makes fundamental analysis so fascinating. It's a blend of art and science. It's about taking all these pieces, the numbers, the industry insights, the qualitative factors, and weaving them together to form a well-rounded view.
So it's like being a detective, but instead of solving a crime, we're trying to solve this puzzle of whether or not a company is truly undervalued by the market.
Exactly. Because if it is, that's where the real investment opportunities lie.
Finding those hidden gems.
Yeah.
But how do we put an actual price tag on that intrinsic value? How do we know if a stock is truly a bargain or overpriced?
That's where valuation comes in.
Valuation, huh? It sounds so official. Like we've gathered all the evidence, we've interrogated the balance sheet, and now it's time to deliver the verdict.
And just like in a real courtroom drama, there's rarely one right answer when it comes to valuation. But there are definitely some tried and true methods that can help us get a lot closer to the truth.
So what are some of the tools in your valuation toolkit?
Well, one of the most widely used approaches is the discounted cash flow model, or DCF for short.
DCF, catchy.
Right. It's a mouthful, I know, but the basic idea is pretty intuitive. We start by forecasting the company's future cash flows. So how much cash do we think this company is going to generate each year for a certain period, say the next 5 or 10 years?
Okay, so we're looking into our crystal ball, but instead of vague visions, we're trying to put numbers on those future dollar bills.
Precisely. But here's the thing. We can't just take those future cash flows at face value. $1 earned in the future is worth less than $1 in our hand today.
Because of inflation. Like
Yeah.
$1 today bought you a whole bag of candy when we were kids, but today.
Exactly. Inflation erodes the purchasing power of money over time. Plus, there's also the opportunity cost of capital. If we had that dollar today, we could invest it and potentially earn a return. So to account for all of that, we discount those future cash flows back to their present value using, you guessed it, a discount rate.
And a higher discount rate basically means we're demanding a bigger potential payoff to compensate for the risk of investing in that company.
Exactly. Risk and return, always two sides of the same coin. Now, I'll be honest, DCF analysis can get pretty complex with a lot of assumptions and variables. That's why analysts often use other simpler methods alongside DCF, like relative valuation.
Relative valuation, so that's where we're looking at comparable companies, right?
Yeah. You got it. We compare our target company to other similar businesses in the same industry, or to industry averages, using a variety of multiples.
Multiples, like the price to earnings ratio or the price to sales ratio.
Exactly. Those are some of the most common ones. So if we're looking at, say, a software company, we might compare its PE ratio to the average PE ratio of other software companies in its peer group.
So if our target company is trading at a much higher PE ratio than its peers, that could be a sign that it's overvalued. Like investors are maybe getting a little too excited about its prospects.
Potentially, yes. Or it could mean that the market sees something special in this particular company. Maybe a superior management team, a stronger brand, or a truly innovative product. That's why valuation is never a one-size-fits-all exercise. It's about considering all these factors together, both quantitative and qualitative, to form a well-rounded opinion.
So we've got our technical analysis toolkit, our fundamental analysis magnifying glass, and now we've even got our valuation methods to help us put a price tag on things. That's a lot of information. For someone who's just starting to explore the stock market, it can feel a bit overwhelming. What advice would you give them?
You know, the most important thing is to remember that investing is a journey, not a sprint. Start by learning the basics, building a solid foundation. Don't be afraid to ask questions, do your research, and even paper trade for a while before you put real money on the line.
It's like learning anything else, right?
Yeah.
Don't just jump into the deep end without knowing how to swim. Start slow, practice, and gradually build your confidence.
Absolutely. And remember, investing isn't just about picking stocks. It's about having a sound financial plan, understanding your own risk tolerance, and staying disciplined even when the market gets bumpy.
Because just like those candlestick charts we talked about, the market will always have its ups and downs. But with the right knowledge and approach, you can learn to navigate those fluctuations and hopefully achieve your financial goals. Well, that was a deep dive indeed. We covered a ton of ground today, from deciphering chart patterns to dissecting financial statements and even valuing companies.
It was a lot of fun.
And remember, this is just the tip of the iceberg when it comes to the fascinating world of market analysis. So if you enjoyed this deep dive, don't stop here. There are tons of great resources out there to help you continue learning and exploring.
Absolutely. Books, articles, other podcasts. There's a whole universe of information out there. The most important thing is to never stop learning and to always be curious. Who knows? Maybe one day you'll be the expert sharing your insights with the world.
That's right. Until next time, happy investing, everyone.